Hey everybody, thank you so much for joining us. We are so excited to go over this data this month. Everything has, just been kind of insane in real estate and really exciting. We have two amazing guest speakers with us today, and I'll introduce them shortly. Do remember that if you have questions during the webinar, please write them in. We will answer those questions towards the end. We will go over a few fun topics in title though, so if you have questions during that section, you're welcome to ask live as well. You should be able to find the question box on your right or left hand side of the screen, and we'll go ahead and jump on in. So before we get started, we do want to go over our disclaimer. If this is the first time that you're joining us, we do this every webinar. We just want you guys to know that we love providing this information for you, and we hope that it helps you in your real estate investment journey, as well as just giving you a foundation of what's going on in the market. But please do your own due diligence before going into any deal. We are not liable, us or our guest speakers, for any investment that you take on after this webinar. We do want to be helpful for you though, so if you have specific questions to a deal, you're welcome to talk to any of our fully licensed loan officers, and we will have a slide at the end with their information. Okay, no more waiting, right? Let's introduce our featured speakers today. We have Markus, he is the president of Priority Settlement Group, and we have Michael, he is the vice president, and we are so excited. These two have over 20 years of experience. Both were promoted at really young ages into their fields, and then they branched off and started their own amazing title company. We love working with you guys. We get nothing but positive feedback from all of our clients that have worked with you as well. And I'll go ahead and pass it over to you if you'd like to tell us a little bit more about Priority.
Yeah, before we do that, one quick thing before we turn it over, if that's okay. I always think for people that are new, building out your team is arguably the most important thing you can do, whether that be contractors, it could be inspectors, it could be wholesalers, whatever it is that you're looking to build. And arguably our most favorite partner in the space is the Priority Settlement Group. Markus and his team, they have outstanding employees. They remedy issues whenever they do arise, which is rare, but they are on top of them very quickly. And that's everybody from Michael, Markus, and their frontline people, just very attentive and involved. So it's a special relationship that we have, and that's why we wanted to have them on the call today. So sorry to interrupt, but Markus, now the floor is yours.
No worries. Thank you for that, Wade and Destiny. And I could say the same certainly about your group. Your professionalism, your due diligence, and all of that is second to none. And from a vendor-client relationship, we're very honored to be working with your group. Fantastic relationship. So thank you for having us on the call today, and thank you for allowing us to speak a little bit about our title company, Priority Settlement Group of Texas. I'll give you a little bit of background on our history. Priority Settlement Group of Texas has been around since 2016 here in Texas, and we started in 2005 with the Virginia Beach located title company called Priority Title and Escrow. And then in 2016, Mike, myself, a couple other people, we joined forces with that group, and we expanded into a national footprint and created its own entity in the state of Texas. So we're going on 5 years here in Texas, very proud of that. Our clients that we focus on are lenders, realtors, investors, the GSEs, right? All of the entities out there. We think we have a really good product mix as far as what we can do, and a really good background and solutions for all of those different clients. We cover the entire state of Texas. I know there's sometimes people asking us all the time, so where do you specialize in Texas? Every single county we can handle. So all the way from the north to the south to the east to the west, which is a lot in Texas, right? But we got it covered. And combined, our management team has over 50 years experience in the industry. So we come with a wealth of knowledge from a title perspective, and we've only ever been in the title space. Mike came from a lending background before, but it's been in the title space for a long time now. One of the things that we really pride ourselves on and try to understand is that we understand that every single deal is important, and yes, we manage by service level agreements. We very tightly track our performance, but we understand that it comes down to every single transaction because that's important to you. Some of the underwriters that we work with, we're very proud of that. We have some really big underwriters: Fidelity, First American, Westcor, And then the newest underwriter we added is National Investors Title Insurance Company. That's a good group that we, just engaged with, and they've been very fantastic. All four of our underwriters are phenomenal. And what that means to you is, different underwriters have different appetite for risk or different ways of solving things in the title space. So sometimes Fidelity may be a little bit more conservative than First American or vice versa. So it's always good to have a number of underwriters in your stable that you can use and brainstorm with around different problems. What makes Priority unique? One of the things we wanted to focus on in building the Texas division is, the premiums are regulated in Texas by the Texas Department of Insurance. TDI is what we refer to them, and all title companies have to charge the same premiums. They're promulgated by the state of Texas, and they're very healthy. And so we wanted to find a way to save money for the consumers. And so on refinance transactions, we don't charge an escrow fee. We don't charge a wire fee, courier fee, mobile notary, mobile closing fee, none of that. On the purchase side, we only charge $199 per side. And then obviously the premiums that are regulated by the state that all title companies have to charge the same for. We do provide, a mobile closing experience, which was really beneficial last year, during the pandemic and everything. But that's what we've built the company on. And that model is we want to try to save you and your clients. We want to save them time in the process. So why come to my office and close if I can take that closing to you, save you the drive time, save you the prep time, the aggravation of sitting in traffic to get your closing done. So we'll bring that closing to you, and we don't charge for that, right? It's a free service that we provide, and how it says there, in their homes, at place of work, wherever it is, whatever is convenient for you at no additional cost. And then the final thing that we really focus on here is our service delivery. We are very passionate about what we do from a title perspective, and we know that it's not about us. It's about our clients in the transaction, and we're going to do whatever we can to facilitate a smooth and seamless closing experience. So, Destiny, if you want to go to the next slide, that'd be good with me. Just to kind of show you real quick what I mean from a pricing perspective, right? Because a lot of talk, oh my God, zero closing for the refi, $199 per side on purchase. We put it in the slide for you here. So the top table there is you see the refinance rates, right? And if you go from left to right, it's the loan amount, what our escrow fees are in orange, and you see 0 free mobile closing fee. The title fees are in green because those are promulgated by the state. So all title companies charge those fees, have to, because the state dictates them. The purple is, 50-6 cash out. There's additional endorsements we have to charge, again, promulgated. And then in the back column, you see the total fee if it was a state straight rate and term refi versus a cash out refi. On the bottom chart is where you see our purchase fees, right? So same scenario. On the left, you have your loan amount or purchase price. Then in orange, you have your escrow fees, and that's where we have $199 per side. And then again in the green, you have your promulgated fees by the state of Texas that all title companies charge the same rate. There is no deviation there. And then on the right-hand side, you have your total fees. So it's a really nice matrix to look at, very quickly to see what is the charge for a transaction with Priority. But fees are really, really important to us. I want to take a second and talk about some title issues, right? That's always the fun part. So enough about Priority. Let's dive into the title portion. And I think one of the most troubling part, which, is when you're dealing with the deceased party. And, the unfortunate news, all of us will be impacted at one point or another in our lives by this scenario, right? But here is the situation. You're dealing with a home, a property, and an owner, there's 2 people vested, multiple people vested, and one of the owners deceased. That is going to happen. That is inevitable, right? And so what now happens from a title perspective, and that's where it gets complicated. The normal process is if somebody is deceased, you go to court, you initiate probate proceedings, and figure out what happens to the estate of the deceased party. A will is submitted to the court, and then a judge rules on, where that estate is going to pass to and who the heirs are that are going to be receiving what's left over from the deceased party. From a title perspective, if that transaction, if it has gone through probate, that'll be our first question. Has it gone through probate? If the answer is yes, then we must look at those 5 documents that are listed there. And those are usually on records with the courts. Some court records are publicly accessible, so we can gather this information directly from the court's website. Some are closed. It just depends on the county and the jurisdiction. But the things that we need is the will, the application, the oath, the inventory and appraisement, and the order signed by the judge, right? When you're passing the interest of the deceased party to somebody and we're trying to sell a home to an end buyer, we have to make sure that that home is passed in its full interest to the new buyer. And this piece allows us to make sure that that is the case here, right? We will determine who was awarded the estate. In fact, in this particular case regarding the real estate, who was it awarded to? And then who is then going to be able to sign the deed to sell that property so the buyer takes possession of that home. Those 5 documents identify all of the details we need. We cannot do it with 4 of them. We cannot do it with just 3 of them. Those are the 5 documents we must review if the situation has gone through probate. Now, probate is expensive. It's a court proceeding. It's going to cost you anywhere from $4,000 to $10,000 to go through that process. It is a lengthy process, just like any other court proceeding is. You have to get dates. They have to be scheduled. You have to go to hearings, so forth and so on. So in some instances, some people have not gone through probate because of time limitation or fund limitation. That certainly happens. So there are a couple of different other options that we can engage in. And so if you look on the right side of the screen, one of the first questions we ask is a vested party and title passed away? The answer is yes. Did they have a will? The answer is yes, and we want to look at it. But the key question here, was the will probated? If it hasn't and they want to go through probate, it's going to take time. But if they don't want to go through probate, we have 3 alternative options. The first one is called the small estate affidavit. It's, again, court proceedings, documents that have to be done. Funds are included in there. It takes some time to, and expensive, not as expensive as a full probate. The second option is a judicial determination of heirship. Another court proceeding, right? Another expense tied to it. Not as long as a probate, but again, a court proceeding. The third option, which we engage quite frequently in this situation, because not everybody gets, goes through probate to get this done, but the third option is an affidavit of heirship. And with our underwriters, remember I mentioned we have 4 underwriters, we have different criteria. One of them may say you have to wait for a year before you can engage in an heirship affidavit process from the time that the person has deceased. Some of our underwriters allow flexibility there, and it's circumstantial. It literally depends on the situation and the transaction. So when we talk about, a deceased party, we want to know all the details, what is going on, what has happened. We discuss with our underwriter, and then a determination is made, if we can waive the 1 year, if it goes to 6 months, if it goes to 3 months. But we have to understand all the variables regarding the transaction and the deceased party. But what happens in the process is we give an heirship questionnaire to the remaining title holder. So the person that's still alive, in title, we give them a questionnaire. And what we're trying to ascertain is who would have been a potential heir of the deceased party. Did they have kids? Were they previously married to another person? Did they have kids from that marriage? So we're trying to identify who are the potential heirs. Once we get that questionnaire back, we then draft what's known as the heirship affidavit or affidavit of heirship. That is then completed by the person in title and 2 corroborating affiants. It cannot be a person that has, interest in the transfer of this property. It has to be a disinterested party. A good person would be, a priest at a church, a neighbor that doesn't have any blood relationship to the deceased party, a teacher maybe, but there has to be some level of knowledge of that person. And generally we say we expect them to have known that person for at least 10 years. Once those documents come back, executed and all that stuff, we take those documents and we would record them prior to the deed and the deed of trust if there's a lender in the transaction. That process can take anywhere from 2 to 3 weeks if all the parties cooperate in this process. This is a lot of handing off that goes on there. So if everybody cooperates and works together, it usually takes about 2 to 3 weeks to get this done. And all we have to do is get the heirship affidavits created, which is an attorney prepared document, which costs about $275. But that process, 2 to 3 weeks, $275 versus $4,000 to $10,000 and months of probate, is a great alternative to that process. But keep in mind, it requires, everybody to work together to get that done.
If I might add a little bit on that, this is one of the great things about Priority in general, is that they're a very investor-friendly title company. And this particular option, a lot of title companies are not comfortable with, certainly not experienced and savvy in getting this done, because it's not an easy process to get third parties to do this. They have to understand the implications and everything. So working with an experienced investor-friendly title company really does make a big difference. And if you're either a person who's out looking for distressed off-market opportunities, or if you just happen to be an investor and you have a family friend who may have, their parents passed away and they don't know what to do with the property or whatever the case may be, this can be an excellent option, both from a time perspective and a cost perspective, for them to more easily move on to the next step of their life without having this home that can sometimes be a real burden when people are already going through a lot emotionally from the passing of a parent or a sibling. So I think this is an excellent option in those situations.
Mm-hmm. Another hot topic from a title perspective, and again, I would say, as a society, we probably go through this more than we should, but it happens. It's a fact of life, right? People get married, and then for whatever reason down the road, a divorce takes place. There is one thing that I always lead off with when I talk about divorces. Texas is a community property state. And what that means, it impacts the property that you own when it comes to real estate and other property, right? But particularly real estate is impacted when you're married and going through a divorce. And in Texas, here's the thing I always say. There is no, half pregnant. There is no, you're either divorced or you're not. There is no in between. Well, I'm going to get divorced in 30 days. Can't we just circumvent? No. You are married. You are married until you're divorced. And that's two separate worlds, right? So that's really, really important to always remember. Here's the key thing, some of the key things that we look for in a divorce. The first thing that we want to request or get, if it's publicly available, is the divorce decree. That is the document from the court signed off by the judge that outlines to us what happens to the property of the two parties that are going their separate ways. All of their properties and possessions are going to be listed in that. We are particularly looking at the real estate section of that divorce decree, but we don't just limit it to that section, because sometimes divorce decrees are tricky in the way they word them. So we want the entire decree to see if there's any other references made. I'll give you an example. We had one decree where there was a real estate section, and there was 30 pages of this decree, so this was a long one, but it was like on page 7. On page 29, it made a reference to the real estate that was listed on page 7. So we have to read the entire decree because it matters. It matters to who was awarded this property, who now can give, or sign a deed if they were selling it, or if they were doing a transaction going forward or doing something with it. Who has the ability to sign on this deed or deed of trust pending, after the divorce is finalized? So another thing that happens usually from a divorce decree is there'll be references in there about a special warranty deed where the ex-spouse that is not, or that's being divested, has to give a warranty deed to the spouse that is going to remain entitled, right? So they're essentially relinquishing their ownership in the property as defined in that decree and ruled by the judge. So a warranty deed is generally recorded. However, if the divorce is new, it just happened, and we have the divorce decree. In Texas, you have a 30-day appeal period on all final decrees. And so we have to wait out that appeal period. So if they just got divorced last week, we cannot close, in a week from now, because there's an appeal process that can take place, and that decree may not be the final one if either one of the parties appeals the decree that the judge signed. So that's really, really careful. And we have to make sure that we watch very closely for when the decree was executed and signed by the judge versus what day is today. On the right hand of the slide, it's not uncommon for a lien to be created in the divorce decree in favor of the ex-spouse. That's known as an old T lien. I'm sure you guys have heard that before. Maybe the spouse, or the the spouse that's going to remain in title doesn't have the funds to pay out the spouse that's being divested. So instead, what they're doing is they say, okay, we're going to create an old T lien on title against the property for specified in the amount in the decree, and then the remaining spouse can sell the property, pay off that old T lien through a transaction, or they can refinance a rate and term refinance. This would not be a 50A6 cash out loan if it was a homestead. It would be a rate and term refinance because you would pay off a deed of trust and you would pay off an old T lien, right? So you can certainly use the property to cover the cost and pay the spouse that's leaving out, not at that time, but at a point that you're either selling the property or refinancing the property. And that's really it from a divorce perspective, but these are very, very complicated situations. So I thought specifically talking about, deceased parties and divorces in an investment scenario are very important to know. And thank you, Wade, for saying that, these are complicated things, but our staff is really, really familiar with these. And we always talk to our underwriters because we got to get it right. So there is no issue down the road when it comes to transferring, ownership of title or the property to another buyer.
Yes, and to Marcus's point, having as many different underwriters is a huge advantage for them because they have deep relationships with them. And there are times whenever one company will have a more open-minded approach to a particular issue, and those deep relationships really help you as an investor get transactions done that you may not be able to get done if you were working with someone who was just had one underwriting team that was more stringent, right? Because at the end of the day, once you get the insurance for the transaction, whatever issues were there before, that insurance policy is there to protect that you are the right and full owner of that property once you get beyond it. So complicated title situations, once remedied, are kind of in the past. So working with someone who can help you remedy those items and ensure that you do not have them listed as exceptions to your policy unless you're comfortable with them is a really big thing. All right, great job, guys. So we're going to talk a little bit about who we are for those of you that do not know, and then we're going to go into the market update. We are a group that exclusively focuses on the real estate investor. That is our primary customer. It's not that we can't help you buy your primary residence or maybe do a refinance on your primary, or especially a cash out refi if you are looking to fuel your real estate investment business, but we work primarily with referral sources, agents who work with real estate investors. That's our bread and butter. We are not out there working with real estate agents to try and find people who are looking to buy a new home or to sell their primary residence. So because of that and our focus, we believe that we can really be a trusted advisor to you to help you through your real estate investment journey. We have a one-stop shop where we provide money to purchase and repair distressed real estate. That's called hard money or maybe private lending. We also provide a wide variety of permanent financing loans if you want to own real estate long term. We are real estate lenders built by real estate investors. I own quite a few rental properties. Most of our employees have either flipped houses or own rentals themselves. We try to take that experience to help you be more successful and candidly avoid some of the mistakes that we definitely have made over the years, which can be costly. But if you have people to help you through that process, you can definitely avoid some of those issues. We have a single point of contact model where whenever you reach out to us, you're going to be assigned that trusted advisor, that loan officer who's going to be able to help you down any path you may go. You may not know if you're going to qualify for a conventional loan or a non-conforming loan. You may not know if you are going to want to do rentals or buy and hold. And we can kind of discuss that and ensure that you can get through that process with a trusted advisor who's going to help you make the right decisions. All of our loan officers are fully licensed. You can normally get approved for all those products with that one credit pull that I mentioned earlier. You're not going to have a credit pull for hard money or the interim financing and the permanent financing. It's all one credit pull, one person. We can normally get you a pre-approval letter in as little as 24 to 48 hours. One very important thing, if you're out there looking for deals currently, is that it's not easy to find good deals. But whenever you find one, you have to be able to move quick because those deals are moved very, very quickly. We have a team that dispositions off-market deals, and they're normally sold within 24 hours, if not sooner. So you want to get pre-qualified before you start looking for deals. The worst thing that can happen is you bust your butt, you find a great deal, and you don't have that pre-approval letter and someone else gets it because you were not prepared to really put the deal under contract. Because if you send in a contract on an off-market deal, you don't have a pre-approval, they're not even going to entertain it. It's cash or hard money only. So you got to make sure you're prepared and ahead of the game. Next slide, please. In addition, as we mentioned earlier, we definitely provide the hard money conventional and non-conventional. We have some very exciting non-conforming products. If you're a full-time flipper or you're a business person who does not have easily documented income and you're afraid that you can't own long-term rentals, you definitely can. There are products that require no income documentation. And we'll talk about this a little bit later, but the margin or the spread between what Fannie Freddie loans for investors are, the interest rates, and what non-conforming no doc loans are at this moment is the narrowest I've seen. And you can get outstanding products, outstanding pricing on those non-conforming loans at this time. We do have non-conventional options as low as a 500 FICO. Now that is not going to be very close to Fannie Freddie pricing. I'll be honest with you, it's definitely higher pricing, but you can get into the business of owning rentals and the power that comes from owning rentals and building wealth over time, even if it's a higher interest rate and higher fees, is very important. If you're a flipper who's well capitalized, we have some outstanding VIP flip programs, great pricing, points as low as 1 point, and some other flexibilities that you get. And as I mentioned earlier, we have a disposition team. So if you're in the market for off-market deals, please reach out to us because we bring off-market deals and we provide a lot of information. How we built the after repairs value, the comps we use. We actually provide a repair budget that we think is appropriate. You always have to do your own due diligence, but we do try to make the process a little bit easier for newer investors. Great, so this is what I was talking about a few moments ago. Mortgage interest rates, where is the market right now? So historically, we still have some of the lowest rates that this country has ever seen. But they are a little bit higher than they may have been a few months back, still historically low. But there have been some things that have taken place. So there is a regulatory change. Fannie Freddie lowered the maximum amount of non-owner occupied loans by a lender that can be delivered to Fannie Freddie from 17% to 7%. So this is an effort, in my opinion, to increase homeownership and to provide fewer loans to landlords, right? That did have some implications across the market. Interest rates got a little bit higher. The guidelines shifted a little bit. I think that's going to balance out over time because the guidelines basically went retroactive to the beginning of the year, saying that 7% cap is in place retroactively. So for people who are already above the cap, they literally could not deliver any more loans to Fannie Freddie until they got that number back in line. With that said, we think that's going to normalize, but what has happened is that Wall Street and other money has come into the market to fill that gap with very, very attractive pricing, as I mentioned earlier. So it's really sometimes challengers are the catalyst for innovation, right? And there's a lot of new products coming into the market that really make it attractive for real estate investors. And we think that the desire for those is pretty astounding. I spoke with several people at a recent convention down in Miami that are work for some of the biggest capital firms in the country, hedge funds, institutional money, and many of them said that single family rentals is the most desired asset class of all asset classes. I'm not just talking about real estate. I'm not talking about comparing it to commercial or comparing it to multifamily. I'm talking about all asset classes. Single family rentals are incredibly desirable at this moment. Not only investing in them, but also the notes that we provide. Like when we provide a loan, there are people that really want to own those notes that you will have to provide you the financing to hold that property long term. So I think if you're thinking about it or are in real estate investment, that's just more evidence that it's a great asset class to be in. This next slide shows the historic rates, and if you haven't seen this chart before, it can really be astounding. If you look at this, the highest interest rates were almost 18% back in 1980. It's hard to imagine, right? I mean, we have such low interest rates right now. Most people do not know that interest rates were that high at one point. And what's very interesting about this chart, and in previous meetings, we've laid these charts down side by side with the inflation chart. And with the amount of money that's being pumped into the system, I think inflation is almost inevitable, right? And what happens whenever inflation increases throughout history, it doesn't move in direct correlation, but it moves very similarly is that interest rates also increase. So if you're able to get into real estate at historically low rates, you know, maybe in the 3s, low 4s, wherever you're going to be, and inflation does come, what that means is that you have an asset that is you've leveraged at a very low interest rate, and then inevitably rents will increase if inflation goes up, right? Other people are going to be borrowing at higher interest rates in order for them to cash flow. Everything's going to start to rise, but you're locked in at that very low fixed rate. And this is how real wealth can be built if you're able to lock in at times like this, because if you look at this chart, there was never a time when rates are as low as they are right now, and it could be a great way for you to build that wealth for you and your family. Next slide, please. I want to give Michael and Markus a moment. What are you guys thinking about rates before we move on to this next topic?
Mike, you want to start or you want me to start?
I can go. You know, it's kind of curious right now. You know, I think they're going to hover. You know, I actually sit on the panel with the Dallas Fed monthly, and we just did a quarterly webinar, and they plan through 2023 to hold interest rates, the overnight rate, to at or near zero. And while, you know, that's not a direct correlation to, you know, mortgage interest rates, it does have an effect on the 10-year, and the 10-year is still hovering historic lows. I think rates actually just, correct me if I'm wrong, but I believe they just came down a little bit in the last week.
They did.
And, you know, one of the things on the last slide you had that caught my attention was borrowing and, you know, getting properties now at this historic low means that as people aren't going to stop borrowing money for investment properties. But as interest rates go up, mortgage payments go up, you're going to have to charge more for rent. So if you're down here, you're just by the natural flow of the market, as inflation comes in, you're going to be able to raise your rent on your buy and hold properties. So you're going to realize a better gain than you were happy with at the low rate and the lower rent. So inflation is not bad for the type of business we're talking about today.
Absolutely. It's a great hedge against it, and it's a great way to increase your cash flow. Markus, any thoughts?
I think Mike covered it perfectly. There's nothing to add, Wade, from my perspective, but he's 100% right. I agree completely.
Great. So next slide. This is a very interesting situation that took place in Houston. So, I'm sorry, I may be jumping ahead. This was in this article in the Wall Street Journal. I'll talk about these two bullets and I'll tell you a little story from that article as well. So this is in the Wall Street Journal recently. This John Burns Real Estate Consulting Fund found that Houston was a favorite place for investors, and that 24% of home purchases in the greater Houston area have been by investors. It's really an amazing number, and a lot of it is institutional money. You know, you always talk about the smartest people in the room, the hedge fund, the private equity types. They are choosing Houston as a primary spot. We actually work with a hedge fund out of California. They've raised well over $100 million just to put into single family, and they are only investing in one city in the country. They're from San Francisco. They're not investing in San Francisco. They're not investing in LA. They're investing in Houston, Texas. And this, as a provision of how they raise the money, that is the only place in which they can invest at this time. So that's a pretty strong testament. They also expect home prices to climb 12% this year on top of last year's 11%, then increased to 6% in 2022. So there's a lot of talk, and I believe that obviously there are challenges that we've gone through. I don't think that the challenges were as big as most people, including myself, anticipated from the pandemic. We've actually weathered it relatively well. But real estate in particular has just been on a boom since this has happened, right? And 12% this upcoming year is a very, very strong number. I mean, normally the long-term run rate over the past 10 years in Houston has been below 6%, but still steady and strong. So this is what people anticipate happening going forward. In the same article, it mentioned, I don't know if we have a slide on it or not, but I'm going to tell the story. D.R. Horton, which is one of the bigger builders nationally, built an entire community with the intention of selling it to owner occupants. And I believe it was up near Conroe. And rather than selling it to owner occupants, they saw an opportunity. They leased out the entire neighborhood, and then they sold it to a private equity fund at a significantly higher margin. I think the number was 50% higher. They made 50% more money than they would have made if they sold it to owner occupants.
Yeah,
Right?
it was 50%. I'm chiming in.
Yeah. How much more was it?
I think it was 55%, but it was definitely over 50. It was pretty shocking. They sold it to a fund that had 150,000 individual investors in that fund.
Yeah. So that's an amazing story, right? They see so much value that they were willing to pay, I guess, 50% more than owner occupants would for properties in the greater Houston area. And anecdotally, we had one employee on our team, Austin, who had a family member who he looked at the numbers, and Austin really knows how to determine the value of real estate. And I think he estimated the value to be 180, and there was a hedge fund that offered 208 on the property, and it was not even repaired. He said it would be 180 if they put 15,000 into it. So as I mentioned earlier, there's an insatiable appetite for rentals, especially in Texas because of the affordability index. If you guys don't know what the affordability index is, it's always a great leading indicator of where markets are going to go for real estate. And Texas has always been, in general, one of the leaders. Austin, not necessarily so much anymore because it's gone up so much, but the affordability index and the other major metros in Texas is really amazing. And what the affordability index means is what the average income is in an area versus the average cost of owning a home, right? And that affordability index in Houston is always one of the top, if not the top, of the top 20, 50 major metros throughout the country. And San Antonio and Dallas are also very strong in that category. Austin, which we'll talk about in a bit, has had massive appreciation recently. Markus personally experienced some of that, and we'll talk about that in a bit. But yeah, it's just the rest of the markets are still very affordable and good for rentals. Let's dive into that Houston data next. And Michael and Markus, please opine anytime whenever you have a comment here. But we always look at this chart, and it really just shows a couple of things. One, there aren't that many homes available in these lower price points anymore. The sales numbers are down significantly. And I think the significant amount of appreciation has a big part in that. But what's also pretty amazing is how many more homes are selling in those upper tranches, right? And in the past, I had always personally been, and a lot of other real estate investors have been reluctant to move into those higher flip areas, but the days on market are incredibly low in those categories as well. Those more expensive price points across Texas, but also specifically in Austin in particular, like the higher price points are just flying off the shelves in that particular market. I'm sorry, I am on a different slide than you are.
Yeah, I was thinking that. I was like, oh, we're jumping in.
I moved ahead on my own slide. I always have my own slide over here to the right. So I'm sorry. Thank you for bringing that to my attention, Destiny. We'll go through the actual slide instead of one that I was looking at on my own without everyone else. So single family home sales increased for the 10th consecutive month, up 24%. Days on market for single family homes dropped from 65 to 45 year over year. That's an amazing, that's a huge drop in days on market there. Total property sales up 31% year over year, huge jump. Total dollar volume up 55%, which also speaks to that next chart, which I was talking about, which you did not see, that not only are sales going up, but the price point of those homes is really going up. There's a lot more turn in that higher price market across the state. Single family average price up to a record high, 20% year over year, pretty crazy. Single family median home price up 16%, also a record high. Single family month of inventory. This is a great indicator of the market. And as we talked about in the past, equilibrium is 6 months supply of properties, right? In Houston, we are currently at a historic low of 1.4 months, down from 3.4 months a year ago. And that's a hard to fathom number, and below the national inventory of 2 months. Single family home rentals fell 17%. That's the numbers. How many were leased, right? There's just not enough inventory out there in all categories. But the average rent did go up 9%, which is a major increase in rentals. I will say over time, rental rates do not increase as quickly as home sales. If you think about it, it's because those only come up once a year, and it's a little bit more difficult sometimes to get upward pressure on rents at times. But in times of massive appreciation, rents do not always move in exact lockstep. It's normally a longer tail for the rents to catch up to the increase in home prices. Marcus, what are you guys seeing in Greater Houston?
You know, the numbers.
You're asking? Yeah, go ahead, Mike.
I was gonna say the numbers I had today were pretty similar to what you just went over, Wade. And you know, one of the things, I'm going to use a personal situation. I know Marcus is with the housing market. You know, due to a life event a couple of years ago, I now have a blended family, and we were renting because we had multiple kids in multiple school districts. So we didn't know where we were going to land. So back in the fall, I decided to jump back out in the housing market and go buy our family home. Well, if you know what's going on in Austin, which it's going on in Houston, the numbers are showing it. I literally could not get an accepted contract no matter how much money over asking I threw. And to bring it back home to make it relevant to this, so I am currently now in a long-term lease in a beautiful house, but I'm in a long-term lease for an amount that I actually never thought I would pay for rent because I couldn't get in the market. So where it's going again for landlords, and what I've noticed as I was researching this today, the cool part is you can move into those higher price points if you have the appetite for it. But what it's also doing is pushing younger families, people further out from the city. So places you would not have opportunity to buy distressed properties, rehab them, get fantastic rents for. You know, you're now looking, Conroe pops up, North Conroe pops up into my mind, right? You know, people are like, well, I got a rental out there. Well, I work in the city, right? I don't want to make that commute every day. But if you can't find a house in the city and you look at renting and you're renting an apartment for now what's, knocking on $1,500 to $2,000 for a 3-bedroom, an hour commute's not that bad for, a $1,400 house.
Sure.
So your market for these properties and for the consumer is getting tremendously larger. So I think it's all playing into the favor of buy and hold.
Yeah, Wade, on my end, I'll tell you my personal situation, right? In my experience, my wife and I, we bought a house 3 years ago out in Bee Cave, which is southwest of Austin, about 25 minutes outside of it. And we were going to sell it in the fall at a 22% profit compared to what we were going to, what we paid for it in 2017. That deal, fortunately now fell through. The buyer had some issues that come up, had to let go of the contract. We didn't want to sell anymore. It was too much of a hoopla. Today, then in the fall, I would have made 22%. Today, if I were to sell it, I would be at 84%. So in a matter of 4 or 5 months, you're talking about a 60% increase in profit in just my home. And it's, in Austin, it's wild, right? Because we really have a low inventory out there. And you have a lot of people that are trying to buy, moving here, right? You have all these companies coming here, building infrastructure, Tesla, Apple, Amazon, right? All that stuff is coming here. And so you have a lot of people that are investing in Austin, moving to Austin, being relocated out here. And it's really, an interesting piece to see in Austin, Texas. It's wild.
Yeah, no doubt.
One more caveat to that too, what it's also doing, I just started playing around looking at some of these numbers, but your younger families, your younger investors, people are not coming to Austin, right? The younger generation is not coming here. They're leaving here. For the first time that I've been here, and I've been here 32 years, I'm reading a stat on, the 25 to 35-year-olds, they're going to Houston. They're going to Dallas. Mm-hmm. They're going to San Antonio. They're leaving here because there is no way, even if you're making 75 grand a year, that you're going to be able to own anything. So that's called, which is great for you guys, right? I mean, it puts pressure on your market, but you're going to have a whole new influx of people that, what do people do when they go to a new city, right? 9 times out of 10, they rent, right? Because they want to find out, do I want to live here? Do I want to put roots here? So again, the rental market, I just think it's, I just think it's a perfect time to be in this industry.
Great time for flips too, but especially the buy and holds. But the flips are flying off the market as well. We listed a flip for some people, which is another service we do provide. And first weekend we had 21 offers, I believe was the exact number, and got a price well above ask. Full cash, no option period, no outs, no inspections, no anything. Kind of amazing, honestly, how competitive the market is. And people, to Michael's point, just have to put things in a contract that, candidly, before the pandemic, they never would have considered making an offer that way, because you didn't have to, right? It's all competitive forces. But in order to beat other people out, people have to do some relatively absurd things to get the deal, because it's just not a time when you can try and negotiate price at all. You always got to be over asked. You always got to do some unique things, waiving inspections, waiving option periods to get those deals locked up.
Have you seen the new form that Trek issued this week?
I've not seen it. What was it?
Okay, so and I'll get you a copy of it. I saw it yesterday, where they now have a form and they're asking agents to include it with their contract, where it's advising the buyer of a property that this, and this is all of Texas, not just Austin, that this is an extremely competitive market, and that offers, way over appraised value, they're fine, but they need them to know that the housing market may not hold that number. So they were just warning people, right? They're covering the agents and saying, this is an extremely volatile, evolving market. And so be prepared, for unexpected things. It's a really, I'm butchering it, but it's a really great read. But it says exactly what we're talking about today. The market is hot. The market is, you're doing things on contract. I mean, I'll tell you, again, in my little experience trying to buy a house, I'm not in a low price point. I went on one deal $150,000 over asking, all cash with an appraisal waiver on a VA loan, and didn't get it.
Wow.
So, it's a crazy time in the market. But again, if you're flipping, I talk about buy and hold all the time, but if you're doing flips, while you shouldn't expect offers like that, I think you're going to see a lot more for the next, I think through the summer selling season at least.
Yeah, I think at minimum. We do have a few more slides to get through before we get to questions. So let's I think I've already covered this slide here. So we'll go on to the next one. Sorry, you guys didn't get to see it, but I guess you got to hear about it. So it's the next slide. It's a summary, just a couple of different visual presentation than what we covered earlier. But I mean, if you look at these main numbers, the single family inventory, only 1.4 months of inventory, as we talked about earlier, 2 months less than last year, just a massive drop. Big increase in overall property sales, dollar volume. Total active listings down 43%. With much greater turn, that just tells you how hot the market is and how limited the inventory is. We keep thinking that sales are going to go down because there's not enough inventory, but what we just see is just compressed days on market. As soon as things come on the market, they're just turning in every one of these Texas markets. Next slide is San Antonio. So if you look through the numbers here in San Antonio, the sales are up 16%, average price up 15%, average price per square foot up 14%. So a lot of really strong numbers there in San Antonio. The residential rental market, total number of rentals are down. That's the same thing that we saw in Houston, right? Limited inventory. But the average price up 11% year over year. So like Mike was talking about earlier, you go and you start renting a property for $1,500 a month, you're making $400 cash flow. That's great. You're happy with it. But according to these stats, it goes up 11% year over year. So your cash flow goes from 400 to 550 in a year because your rents went up from 1,500 to 1,650 in 1 year. That's nice for really just a market growing, right? So that's the type of things that we're seeing right now. Next slide, North Texas. So this is the greater DFW type market up there, right? Greater Dallas-Fort Worth. Comparable numbers, a median price up 14%, active listings down 53%, months of inventory 1.4 months. I can't see compared to 3.
Compared to in March, yeah.
Yeah. So literally half.
Mm-hmm.
Literally half from last year. So North Texas also very hot market. Next slide, please. And Austin, as we mentioned, both the stories that Marcus and Mike relayed, and just in general, without question, the hottest market in Texas, and probably one of the hottest, if not the hottest in the country right now. That months of inventory, 0.4 months, I don't ever remember seeing anything like it. It's almost absurd to think about 0.4 months whenever 6 months is equilibrium. Down 1.4.
Yeah, we were shocked with 0.98, and I think that was 2 months ago. We were like, wow, this is crazy. And it just keeps getting lower and lower. It seems like got to get it before it's gone. It's kind of feels urgent. And Michael, I know that you and I were talking about this a little bit when we were going over the slides last week, and you had some information on what you think is going to go on in Austin in the near future. Would you like to share that with our audience?
Yeah, absolutely. So, been talking with a lot of brokers in the area, and we're actually seeing it happen now. The market looks like it's cooling off, but what happened is all of these cash over asking and over appraisal offers that went on during, November, December, January, and they've all started to close. So the house that was a great deal in somebody's mind, back in February before the storm, was still appraising at, let's say, $468,000. But all of those deals have closed now. And with those deals closing, the new comps are out. And so, that house that was, 4 and change is now north of 650. So the market is slowing down, but the price points are dramatically increased. My neighbor just put his house up for sale because he owns another house down the road that's free and clear. So he and his wife want to see what they can get for it. The value on the house on the county records, which we know is a little low, but the value on the house is $489. He's got the house at $850. Right? I mean, so yeah, the market just kind of, when you get all these crazy cash over offers, eventually, right, you will rise the price point. Case in point to Marcus's story. That is exactly what happened. He's in a smaller subdivision, but literally that's what happened. The price points and all the extra cash that went into the neighborhood, took his house that was under 3/4 in just a short amount of time to over $1 million. I mean, where do you see moves like that? I mean, this looks like California in 1990.
And it's interesting. There's always a difficulty in home prices going up whenever all the deals are financed, right? Because if you think about it, the previous sales are kind of an upward ceiling on how much property values can go up. But whenever you're in a heavy cash offer market, things can just go through the roof. And that's what we're really seeing in Austin. We're seeing it to a lesser, but still a strong extent in the other places, other major metros. But in Austin in particular, all the California and East Coast people that are moving into the area are a significant amount of time making the cash offer. So there is no appraisal required for that. So there's not going to be a downward pressure because of the appraisals and people coming back and renegotiating. And I think that's one of the reasons we're seeing this epic amount of appreciation there in Austin and throughout the state.
Oh, and Wade, another good point, you know, to purchase property and hold it. You know, again, in my own personal situation, right? Had I sold my house in October or November when it was, I'd have lost out on 60%, right? This is one of those times where if you can get your hand on a property, ride that equity wave it's going to give you right now. It's awesome.
Yeah, it's incredible. Okay, got a few more slides to go, and then we'll get to some questions.
Yeah, we have 2 or 3 right now. So if anybody has another question, feel free to write it in. It looks like we're going to go just a little over time, but we are going to talk about Texas all over. Wade, I'll go ahead and let you start this one if you'd like.
Sure, and this comes from Texas A&M. They do a very in-depth statewide real estate evaluation every month. Throughout the state of Texas, 1.5 months of inventory, which is an all-time low. We saw in each of the major metros we've covered same information, although I would say even more extreme probably in the major areas over the smaller towns. Total sales statewide were down, mostly due to the winter storm. So I think
this one is, so all of our other data for all the metros that we've had so far has been the most recent, which is March. And Texas is about a month behind. So this is the February data. So that's why it's probably going to look a little, I guess, different from the others.
Absolutely. But a couple other things, houses below 300K were well below 1.2 months of inventory. So that lower price point is moving more quickly, although the higher price points are moving historically fast as well. Median home price throughout the state up 13% year over year. Repeat sales home price index up 10.4%. And then the delinquencies, this is something to keep an eye on. You know, nationally, it's at 7%, and Houston is higher than some of the other markets. That's been a relatively steady trend. So if you are a Houston investor, I don't know exactly what that means. We still believe in the Houston market, but it is something to keep an eye on because the delinquencies are a little bit higher here than they are in some other markets. Now, I do want to remind everybody of one reason why I think there's not going to be a huge foreclosure situation. And the primary reason is because of how forbearances are being handled differently than they were handled in the previous financial crisis. In 07, 08, 09, whenever someone had a forbearance, at the end of that forbearance period, they were required to make all of the payments at one time, right? So if you had a 12-month forbearance, you couldn't make a payment at all for 12 months. It's pretty illogical to think that all of a sudden they're going to make 12 months of payments, right? And then it just didn't make sense. So they had to either qualify for a loan modification, which means you had to get qualified for it. You had to actually prove credit worthiness, or you would get foreclosed upon. Conversely, with this time, people do not have to pursue a modification. They're not going to have to get qualified for a loan. All they're going to have to do is tack it on to the end. So in other words, it was a 30-year mortgage before, now it's a 31-year mortgage, right? That is such a compelling difference that there are going to be foreclosures. I'm not trying to say that there are not going to be any, but it's hard for me to see with that difference that it's going to be anything like it was before. So do keep that in mind. I think a lot of this delinquency will find a way to work itself out over time. While there will be foreclosures, I don't see the boom, and I think a lot of other people don't see this massive foreclosure crisis coming up. A couple other quick things, days on market. We've talked about this a lot, but you look at that days on market trend. Can we get to that slide, please? Thank you. One back. Yep. Look at the days on market for new and existing home sales, just incredibly low. Huge drop there. Next slide. This is one that I find very interesting and is an ongoing trend that we've been seeing since we've been doing these presentations and since I've been looking at this data. But the gap between existing home prices and new home prices, look how much it is shrinking. Existing home prices are almost in line with the new homes. That tells you a lot of things. One, there's just not enough new home inventory, right? And Texas is building a lot of homes. In a previous meeting, we discussed the Dallas-Fort Worth area in and of itself has more new construction of single-family properties than the entire state of California. And Houston is not far behind that number. So there's a lot of inventory, but it's not enough to satisfy all the needs. So that's why existing home prices are continuing to go up, because there's just not enough new homes. Just like, you know, most people are going to prefer a new home or a new car if it's available. But if it's not available, they still want to get into a home, and that's going to continue to increase those existing home prices. Next slide, please. So this is a report that kind of covers the actual current time. The blue and red lines are Texas blue. Red is the national number. So you can see that the construction index is going up. A lot of homes are being built, but the Texas leading index, that is analyzing future new construction, permit requests and things of that sort. You can see that number really jumping up to a number higher than pre-crisis, like 2006, if you see that. So that in some ways might be concerning, but I do think that there's so much demand right now that I don't see that being a huge issue either. Although if you look how much we were down for a very, very long period on new home construction. So there definitely is an opportunity to sap up some of that demand with new homes. So that is the presentation that we have. I think if everybody is interested, we're going to answer questions for a few minutes here. Marcus and Michael, if you have another obligation, I get it. Hopefully you can hang on for a few minutes, but let's open it up.
Awesome, and thank you everybody for staying on. We don't normally like to end a little late, but when we do, we really appreciate you guys for hanging on with us. We are recording this webinar, so you are going to get a copy of it. You can review it at your leisure, but if you want your questions answered, you have to ask them now to get them answered live. If you guys are interested in finding out more about Priority, we do have their information up on the screen, so you're welcome to send them a call, add them on Facebook or social to keep up with any events that they're doing, or you can check out their website for more information. Again, if you have a particular deal that you're working on and you want to speak to one of our loan officers, email us at info and we'll get you in contact, and you can set up a one-on-one consultation. It's completely free, no obligation, and they're happy to help you work through whatever project you're working on or interested in getting started. So I'll go ahead and ask, we have a few questions. We have two that are very similar, so I'm going to ask those first. The question, I'm going to ask them both. So one said, is Texas experiencing a bubble in the market? And someone else said, do you think that the market may be close to a bubble? So that is a hot question, and I'm open for anyone that would like to jump on that and answer.
Marcus, Mike, do you want to go first, and I'll take it second?
Yeah, I'll give you my thoughts, right? I'll give you mine, then Mike can go. It was, conventional wisdom and looking at this, what's happening in the market, it's easy to go down that path, especially if you've lived through the financial crisis of 2007, 2008. I think one of the fundamental differences that you have from then until now is you have, our current buyers that are out there. It's good credit worthiness. The loans that are being made are good loans. They're not based on subprime lending, and people are in these homes very well qualified to be in those homes. And so while when you look at the price increase, you would easily think, oh my God, we're approaching a bubble. The underlying fundamentals are much, much stronger than they were in 2006, 2007, 2008. So in my perspective, are we seeing a huge price appreciation? Yes. Do I think it's a bubble? No, I don't.
Yeah, I would add to that. There's a report that comes out, and we haven't covered it here in some time, but we should again, that talks about the credit worthiness of the average loan out there. And to Marcus's point, the subprime market's not there, but it's not just that. Previously, NINA and CISA loans, which are no income, no asset loans, stated income, stated asset loans that were government-backed Fannie Freddie loans, made up a huge part of the market. And that's how people just got into homes that they literally could not afford at all, right? We're in a different environment now where, to Marcus's point, debt to income ratio matters. Like, people have to prove the ability to pay that mortgage. FICO scores are higher than they were during the previous situation. And another real difference is that that situation was a true real estate crisis, right? This has not been a real estate related crisis. This has been a pandemic that the end results were not as bad as I think most people anticipated, and we're coming out of it relatively well. I mean, don't get me wrong, it was a horrible situation for all those people that were impacted. I'm not trying to say that at all, but from a pure financial situation, I don't think it was as bad as was anticipated, but all the things we've talked about, how forbearances are handled differently, especially in Texas, the incredible influx of people moving to the state, which is going to impact that supply and demand number. And then the affordability versus the rest of the country and the income that you can still make here. Job market is very strong, high wages. I think there's a lot of room for property prices to catch up to the rest of comparable markets out there. People are fluid right now. They're moving around, and this is just an attractive place to be because of a strong jobs market and very attractive home prices, even at this point. There's a long way they could go up before we're anywhere near the Californias, the New Yorks of the world, right?
Yeah. And so what I'd like to add to that really quick is expand on what you were talking about, Wade, is from an economist standpoint, if you look at all the major markets around the country, Texas is still price-wise, still very undervalued in our housing. So we have that. We have no state income tax, which makes it, and we offer we offer incentive packages to recruit companies. The job growth in Texas, I'm looking at some stats again from the Fed, and for the last 11 months, we have added over 65,000 jobs each and every month moving forward. And they're not, $6, $7, $8 an hour jobs. These are, 15, 20, so the price that people are getting paid, to come here is going up. So I agree with you. I don't believe there's a bubble. At some point things will change and somebody will always point a finger and go, see, I told you, but it could be in 10 years. You couple that with what you and Marcus just went over with the mortgage rates and the housing and the financing of it and the credit worthiness. And I think we have a very strong market for the foreseeable future.
Yeah, and just to add, right, if you have a strong demand, which is driven by low supply, the supply chain will catch up in that process, which means price appreciation won't forever continue like this, right? That won't be the case. It will, instead of spiking the way it is, it'll balance itself out and find a happy medium between the supply and the demand chain. But right now the demand is outweighing the supply so much that it's driving that appreciation. But supply, which is what we saw on the construction index, is going to catch up to this, and that's when you see the appreciation, drop down a little bit, not spike as much as it is. So I think there's good fundamental, really great points, Mike and Wade, from both of you to answer that question. So
thanks, guys. All right, so our next question. This one is: shall we investors start changing the rules? Start changing the buying rules up, 70% rule, 75%, asking plus repairs. Should we move up the numbers? So I think they're asking, should the LTV become higher because prices are getting higher? Wade, would you like to take that one?
Yeah, I think, that to your point, the question is, what percentage of after repairs value should people be paying in this current market? So I will say, I think it would be where you could make a mistake in real estate investing is assuming that the 12% appreciation is going to continue and saying that I'm going to start a flip and I'm going to anticipate that the price is up 6% 6 months down the road, and that's the number I'm going to use. I do not encourage that. I don't see a drop in prices, but to Marcus's point, there will come a point where we're no longer increasing 12% per year. I mean, that's impossible to continue at that level unless there's just enormous inflation. That would be the one way that would be possible, but it would have to be tied to inflation. That said, I don't think there's anybody buying from wholesalers at 70% on flips and 75% on rentals. I can tell you, we put properties out all the time, and if we put properties out at that point, we'd be so massively underselling our properties that it would not be an intelligent business decision. The market right now for flips is at minimum 75%, if not 77.5, and a little bit more. And a lot of people look at it, if I put $35K into this deal, can I make $35K out of it? That's the way a lot of people look at flips. A lot of mentors and gurus are teaching in that way. And if you think about it, where else can you put $35K out of pocket, make $35K in a 6-month, 4-month period? Like that's very rare. So that's a great return on investment in a pure status as well as a time status, right? To make that money in that short time frame is really good. So on rentals, the market is even higher than that, right? The rentals, we're seeing people pay 85 to 95% of the after repairs value, depending on the market. If you were buying from wholesalers or on the MLS, I don't think you're ever going to find a deal at 75% in this current market. You're going to have to pay significantly above that. And I think there's a lot of factors that go into it if you're looking at rentals. You can't just look at the percentage. You got to look at the cash flow. You have to look at your anticipated appreciation. You know, it's a high appreciation market. There's a lot of other factors to bake in, cash out of pocket. But I would say if you want to be competitive, if you want to win bids from wholesalers, you got to be in that 75 minimum, probably 77.5% on flips, and probably 85% to, you know, maybe even 95% on rental type properties, depending on the market and the other factors.
Thank you, Wade. So our next question is a two-part, and I would just like to say Zarina, that's a lovely name. So their question is, I may have missed something, but do you think this trend will continue in Texas? And is it better to buy now rather than waiting? That's the first part of their question. The second part is also, what do you think the future for small multifamily is? I'm contemplating whether to continue to buy and hold single family homes or to buy one multifamily.
I will give my opinion on those questions, and then I'll turn it over to the guys. I think even if, as Marcus and I have said, appreciation is not 12% every year going forward, which I seriously doubt, I still think it's a great time to get in. And I don't see a situation where you're going to get better deals going forward. Now, I think through this all the time. I remember people that we were working with and other investors back in 2012 saying, man, I'm just going to wait on a correction. And then since then we're up, you know, maybe it's 60% or something like that in certain markets. So in those rental type markets. So it's just not something that you can really time, right? It's very difficult to time in that scenario. So I don't see a big correction where you build a war chest, it's going to be this huge opportunity in the foreseeable future in Texas. I do think that there's some other markets where corrections could be in order, right? Secondly, I think you've seen, you know, in the asset classes, that's why whenever we were talking with these private equity and hedge fund types, there's not an insatiable desire for commercial right now because a lot of people are working from home. So that asset class, a lot of people want to see where it stabilizes, right? Because there may not be this retail space and commercial building appetite that's very heavy for investors for a while. Everybody wants to see where that goes. Multifamily has been struggling. We often show the new construction on multifamily. There's not nearly as many requests for that. Vacancies are up in multifamily. And I think if you think about what the pandemic did, most people want to have their own home. They need extra room because they're working from home. They need an extra bedroom or they need an extra office. They want to have their own amenities. They want to have their own pool, maybe their own workout space, because in times of a pandemic, you're probably not going to go to the gym as often. You're not going to be going into the office, right? Yeah. So I do think that made a difference on big multifamily. Small multifamily, I still see as an opportunity. We have a lot of people doing those 1 to 4 type properties right now, even, you know, 8, 12, where amenities are not as big of a bigger part of the allure. But still, people like that yard. They like their own space. A lot of people have made a move away from being in tight, confined areas and cities towards more open spaces in the suburbs. It's like the opposite move that was happening prior to that. So those are my thoughts on multifamily. I do think there's some opportunities there, but you know, at this convention, all the people we spoke with, SFR is the most desirable category at the moment. Marcus, Michael, anything to add to that?
From my perspective, I would say it is still a great time to buy. You know, I just, from an investor perspective, I would not think that this 12% increase year over year is something that we should consider the norm. I think you still have to be a prudent investor. Do your homework. You know, look for the right transaction. Look for the right deal. But like I said, I don't think we're near a bubble. I think you're going to have, you know, the appreciation is going to slow down at some point. No question, that's inevitable. Like Wade said, you know, unless inflation kicks in, right? Then it could continue like this. But it's going to slow down. So that means it's going to increase, but you still have to do your homework. You know, don't become complacent and think every property is going to be an amazing situation. And that's where Wade can probably tell you more than from our title perspective. As an investor, you always have to do your homework. But, you know, don't let this, you know, there's pessimists, there's optimists, and there's realists. And this is a realistic market right now. And you're going to have pessimists that try to, you know, talk the bubble talk. I do not believe in what we heard here were really good reasons. So if you find a good property and you're an investor, continue investing. Do what you do best.
You know, the only thing I would add is on part 2 of the question, whether to move away from SFRs or to go into small multifamily. I've had a little experience with both. And the problem with, you know, small multifamily is you tie up all your capital in one location. You can't if you have heavy repairs, you can't maximize your rental potential while you have a bunch of construction going on in other units. If you acquire one, you know, single family residence, rehab that, you know, it gives you a feel for a neighborhood. You may want to invest more in that neighborhood. You may decide you don't want to invest more, so you can diversify. Wade brought this up in a presentation we did last month, talking about diversifying your property holdings through certain zip codes. And if you're looking for a bigger return, there are some hot zip codes he can share with you where it's trending better. If you want to play a more conservative approach, you can get a list of those zip codes. But with, you know, I did a small apartment complex a few years back in Detroit with some partners of mine. And when the residents that stayed, as we did some minor updating, all we got were complaints, as it was a 10-unit property, of which 8 of them were pretty much destroyed. And so as we're going in and putting new plumbing stacks in and doing things like that, the complaints, the number of people in and out of your property, the number of opportunities for theft goes way up. And I think the risk is much greater in that area. I would stick with single family residence. That's my personal opinion.
All right. Thank you guys so much for that information. I hope we were able to answer your question. We're running pretty far behind today, so I'm going to ask one more. Thank you so much for joining us. It was really a pleasure meeting you last night. Somebody that we met at a networking event joined us today and has a question. This question is, what is the number of properties one can refinance through Fannie Mae? It used to be 10 properties. So I think they're referring to the change that happened at the beginning of this month. Wade, would you like to take this one?
That guideline in particular has not changed. If somebody is a Fannie direct lender, you can still get to 10, but you do have to have a 720 FICO score. So that is a slight difference. Well, it's not a change in guidelines, but it's just a caveat that I do want to give, is that you can get to 10 in each person's name. So if you qualify individually and you have a significant other, you could each get 10 conventional loans in each of your names. And then after that, we have outstanding, as I mentioned earlier, non-conforming products. The pricing gap is narrowed significantly. So you don't have to think that your cap is just 10 for each or 10 as a family. You can go well beyond that. We have a lot of people who've already capped those things out and moved on to other categories. And you can also do like blanket loans that make the process a lot easier. We're working on a few blanket loans right now, very large, like 69 properties on one, 51 in another, where you know, it's all of those different properties in one single easy payment, which can make life a lot easier while you're sipping cocktails, collecting all your rent on a nice beach somewhere.
Awesome, guys. Thank you so much. I had a few people write in just saying thanks for the great information. So I wanted to pass that along to Michael and Marcus, and just thank you guys for joining us today. Again, if you guys have any interest in learning more about Priority, these two are fantastic at getting back to you quickly. They have a really amazing team, and they are so knowledgeable about title and working with real estate investors. So I definitely encourage you to check out their website and reach out to them. Make sure that you're following us on social so that you are ready for all of the upcoming events. It is getting busy again, and so we are excited to be back out there in the market and meeting people face to face. And again, you will receive a recorded copy of this webinar. So thank you guys so much for joining us today. We really appreciate you hanging out a little bit after time.
Cool.
Thanks, everybody.
Thanks, everybody.
Thank you. Thank you.
Bye, guys. Thanks so much.
Bye.
Bye-bye.